Very good day, friends. In this video, we will do a quick revision, recap, or a fast track refresher of chapter 2, which is on rates of tax. So as we know, income tax is charged for an assessment year in respect of the total income of the previous year at the rates which have been prescribed for the year by the Annual Finance Act. So every year there is a Finance Act which is enacted, and the rates for that assessment year are prescribed in that Finance Act. How do we compute tax on total income? What are the steps? Step 1, we calculate the tax on total income as per the rates prescribed by the Finance Act. From that, we deduct rebate under section 87A if applicable, right? We add surcharge if applicable, which is adjusted for marginal relief if available. And then we add health and education cess, which is HEC at the rate of 4%. And this tax on total income is rounded off to the nearest multiple of rupees 10 as per section 288B. And the steps for rounding off are the same as that for total income that we have noted in the previous video on basic concepts. It's important to note the sequence. First comes rebate, and then comes surcharge, and then finally is HEC at 4%. So first is rebate, then surcharge, and lastly it is HEC. So this is the sequence which we need to note. Coming now to the rates of tax. And these rates are applicable for assessment year 2023-24. 2023-24. We will now look at the rates applicable for individual HUF, AOP, BOI or AJP, artificial juridical person. The rate of tax depends on the range of total income, and there are three situations in which a taxpayer can fall, and accordingly tax needs to be computed. First is a normal case, which is applicable to a normal individual or an HUF or AOP or BOI or AJP. Then is the case of a senior citizen who is a resident individual of 60 years or more. 60 years or more but less than 80 years at any time during the previous year. At any time means even if the person becomes 60 years of age on 31st March of the previous year, then also he will be treated as a senior citizen, and consequently these slab rates will apply. A person who is not a resident is not treated as a senior citizen. Okay, this is situation 2. Situation 3, a case of a super senior citizen who is a resident individual 80 years or more at any time during the previous year. Basic exemption limit is 2,50,000 in a normal case, 3 lakh in the case of senior citizen, 5 lakh in the case of super senior citizen. That means no tax is leviable up to the total income of 2,50,000 or 3 lakh or 5 lakh. This is called the basic exemption limit. Tax rate is nil. Now looking at the normal case where the total income is more than 2,50,000 and up to 5 lakh, the rate of tax is 5% of amount by which total income exceeds 2,50,000. Right? So total income minus 2,50,000 and 5% of that. It comes to the amount of tax. Where the total income exceeds 5 lakh and it is up to 10 lakh, then the amount of tax is 12,500 plus 20% of amount by which the total income exceeds 5 lakh. So total income minus 5 lakh, 20% of that, and we add 12,500. What is 12,500? It is actually the amount of tax pertaining to this range of income. Therefore, we are adding 12,500 here. Where the total income exceeds 10 lakh, what we do? The amount of tax is 1,12,500 plus 30% of amount by which total income exceeds 10 lakh. So total income minus 10 lakh, 30% of that, and you add 1,12,500 to that. What is 1,12,500? It is basically the amount of tax up to the total income of 10 lakh rupees, and therefore we are adding this amount here. This is the normal case. For a senior citizen, the basic exemption limit is 3 lakhs, so no tax up to this total income. Where the total income is more than 3 lakh and up to 5 lakh, then the tax is 5% of amount by which total income exceeds 3 lakh. So total income minus 3 lakh, 5% of that becomes the amount of tax. Where total income is more than 5 lakh and up to 10 lakh of rupees, then what do? 10,000 plus 20% of amount by which total income exceeds 5 lakh. So total income minus 5 lakh, 20% of that, and then we add 10,000. What is 10,000? 10,000 basically is the amount of tax corresponding to this range of income. That's why we are adding it here. Where total income is more than 10 lakh, we do 1 lakh 10,000 plus 30% of amount by which total income exceeds 10 lakh rupees. So total income minus 10 lakh, 30% of that, and add 1 lakh 10,000 to that. That will give you the amount of tax, right? In the case of super senior citizen, basic exemption limit is 5 lakh, so tax is nil up to a total income of 5 lakh. Where total income is more than 5 lakh and up to rupees 10 lakh, then we straight away jump to 20% rate slab. So 5% rate slab doesn't apply to a super senior citizen. Tax is 20% of amount by which total income exceeds 5 lakh. So total income minus 5 lakh, 20% of that is the amount of tax. Okay. Where total income is more than rupees 10 lakh, then what do? 1 lakh plus 30% of amount by which total income exceeds 10 lakh. So total income minus 10 lakh, 30% of that, and we add 1 lakh. What is 1 lakh? 1 lakh basically is the amount of tax corresponding to this range of income. So these are the rates of tax for an individual, HUF, AOP, BUI or AJP. Okay, there is a particular point regarding date of birth. If the birthday is on 1st April of a person, because date of birth helps us to determine whether a resident individual is a senior citizen or a super senior citizen, and therefore it impacts the calculation of tax. A situation could be where a person was born on 1st April of a particular year, right? And therefore a question could arise whether he can be said to have completed a particular age on 31st March of the preceding day of his birthday or on 1st April of that year, right? When can he be said to have completed a particular age? And the answer to this question is 31st March. That is the day preceding the anniversary of his birthday. And this is as per circular number 28 of 2016. For example, a resident individual who is born on 1st April 1963, right, will be 60 years of age on 31st March 2023, not 1st April 2023. He will turn 60 years of age on 31st March 2023 and therefore he will become a senior citizen for previous year 22-23 because 31st March 2023 falls in the previous year 22-23 and accordingly the rates applicable for a senior citizen will apply. Similarly, the cutoff for a super senior citizen will be 1st April 1943 because that person will turn 80 years of age on 31st March 2023, not on 1st April 2023, and therefore he will be a super senior citizen for previous year 22-23. You may remember these cutoff dates for ready reference. 1st April 1963 for a senior citizen and 1st April 1943 for a person to become a super senior citizen for previous year 22-23. The slab rates which we discussed above are not applicable when tax is payable in the form of AMT, that is alternate minimum tax, because AMT is payable at the rate of 18.5% instead of tax at the regular rates mentioned above in the table. The provisions of AMT we will discuss in a later video. Similarly, there is a concessional tax rate regime which has been provided for under section 115 BAC, as per which an individual or an HUF can opt to be governed by a concessional tax rate regime and pay tax at concessional rates. In that case also, if 115 BAC applies, then the tax at regular rates mentioned above, which we just now discussed, are not applicable. We will discuss this regime also in a later video. Now we will talk about surcharge, marginal relief and cess. for individual HUF, AOP, BOI or AJP. So as we have noted above, tax on total income needs to be increased by what? By surcharge and by cess at 4%. And further surcharge needs to be adjusted for marginal relief where applicable. So now we will discuss about surcharge and marginal relief. So surcharge is levied on tax computed on total income. Okay. And it is levied on tax on total income exceeding 50 lakh of rupees. That means surcharge is not applicable where total income is up to 50 lakh rupees. There are 4 rates of surcharge which have been prescribed: 10%, 15%, 25% and 37%. And this depends on the level of total income. However, rate of surcharge cannot exceed 15%. There is a limit in terms of rate of surcharge. It cannot exceed 15% in respect of tax on 2 kinds of income. 1, dividend, and 2, capital gains, but only those capital gains which are taxable at special rate. And these are contained in 3 sections: section 111A, 112 and 112A. Okay, so as we know, capital gains can either be long-term capital gain or short-term capital gain. Now there can be 2 kinds of capital asset. One, a capital asset which is transferred and which is in the nature of equity share in a company or a unit of an equity oriented fund on which STT is payable. Now that, as we know, if it is short-term capital gain, then it is taxable under section 111A at a special rate of 15%. And if it is long-term capital gain, it is taxable under 112A at a special rate of 10%. As far as other capital assets are concerned, if the gain is long-term capital gain, then the general rate is a special rate of 20% under section 112. And if the gain is a short-term capital gain, then the capital gain forms part of the normal income and is taxable at regular rates, which we have discussed a short while ago. And therefore, the capital gain is taxable under a special rate in the case of section 111A, 112 or 112A. And in such case, if we compute tax on such capital gain, then the rate of surcharge cannot exceed 15%. Now this is a table which provides a very quick and easy way to accurately and quickly determine the rate of surcharge applicable while computing tax on the income. So what is important is the level of total income. And this is the rate of surcharge which is applicable on tax on dividend 111A, 112 and 112A income. And this is the rate of surcharge which is applicable on tax on the other income. Now if we see, if the total income is up to 50 lakh, then there is no surcharge. Surcharge is nil. If the total income is greater than 50 lakh and up to rupees 1 crore, then the rate of surcharge is 10%. Whatever be the nature of income. If the total income is greater than 1 crore and up to 2 crore, then the rate of surcharge is 15%. Okay. If the total income is greater than 2 crore, then we need to see what is the level of the other income. That means we need to break the total income into 2 parts. The first part will be that income on which surcharge is limited to 15%. That is dividend 111A, 112 and 112A income. And the balance will be the second part, which will be the other income. So where the total income is greater than 2 crore, then we need to see what is the component of other income. If the component of other income is up to 2 crore, then the surcharge will be 15%. However, if the component of other income is greater than 2 crore and up to 5 crore, then the rate of surcharge will be 25%, but it will remain 15% restricted on tax on dividend 111A, 112 and 112A income component. Now, if the total income is greater than 5 crore, then the rate of surcharge will rise to 37%, which is the maximum rate of surcharge, but it will remain limited to 15% on tax on dividend 111A, 112 and 112A income. So if we look at this table, the rate of surcharge on dividend 111A, 112 and 112A incomes is restricted to 15%. However, in respect of tax on other income, it starts from a rate of 10% and can go up to a rate of 37%. Now, having determined the rate of surcharge and calculated tax plus SCE, we need to determine whether marginal relief is available. Okay. And basically, while computing marginal relief, as you can see in this table, we need to ensure that the tax plus SC, that means the aggregate of tax and surcharge that we calculate normally as per this table, it cannot exceed the following. That means the amount computed as per the following formulae. So this is what we need to ensure. And there is a purpose and objective behind marginal relief, but that is beyond the scope of this video because this video is a quick summary of the provisions. So we are not going to discuss that. We are just going to see what is marginal relief and what is basically the formula for computing marginal relief. Okay. So basically marginal relief provides that if the total income exceeds X, what is X? It's basically the threshold at which SC is levied or its rate changes. So what is that threshold? The threshold at which surcharge is levied or its rate changes is basically a threshold in terms of total income of 50 lakh, because beyond 50 lakhs surcharge starts getting applicable. And then the rate changes from 10 to 15% at a level of 1 crore, from 15 to 25% at a level of 2 crore, and 25 to 37% at a level of 5 crore. So 50 lakh, 1 crore, 2 crore, 5 crore, these are the threshold levels that we are talking about. So basically, marginal relief provides that if the total income exceeds this threshold, X, then the total amount payable as tax and surcharge on such income, the total amount payable as tax and surcharge on such income shall not exceed. It shall not exceed. So there is a limit. It shall not exceed what? It shall not exceed the total amount payable as tax and surcharge on a total income of X by more than the amount of income that exceeds X. So the total amount payable as tax and surcharge, see, tax and surcharge cannot exceed the following. The total amount cannot exceed the total amount payable as tax and SC on a total income of X. That is the total income for the threshold. So total amount payable as tax and SC on a total amount of X. So tax on 50 lakh, tax on 50 lakh, tax plus surcharge on 1 crore, tax plus surcharge on 2 crore, and tax plus surcharge on 5 crore. This is X, basically the threshold. So it cannot exceed the total amount payable as tax and SC on a total income of X by what? By more than the amount of income that exceeds X. So amount of income that exceeds X is what? Total income minus 50 lakh, total income minus 1 crore, total income minus 2 crore, and total income minus 5 crore. So this basically provision translates into this formula. And what is the formula? Depending on the levels of total income which you can see in this table, you need to compute two things basically. You need to, in effect, compute two things. Thus, you need to compute A. What is A? Tax plus surcharge on the total income without marginal relief. That means without incorporating marginal relief, ignoring marginal relief, as per the normal manner, you need to compute tax plus surcharge as per this table. So amount of tax is what we compute as per the slab rates which we discussed before as per this table. Okay. And surcharge, the normal surcharge is something that we compute on the basis of this table. So tax plus surcharge becomes amount A. Okay. And then we need to compute amount B, which is computed as per the formula given in the table above. And the formula, the logic for formula is what we just now discussed. So it will be tax plus 50 lakh plus total income minus 50 lakh, or this 50 lakh will become 1 crore or 2 crore and 5 crore, and total income minus 50 lakh will become total income minus 1 crore or total income minus 2 crore or total income minus 5 crore, depending on the level of total income. So depending on the level of total income, we need to compute B. And then what we need to ensure is that A should not exceed B. That means the rate, the tax and surcharge that is payable, it cannot exceed the amount computed as per this particular formula. And if it exceeds, then we need to bring down the amount of surcharge. Okay, so that amount by which we bring down the amount of surcharge is called marginal relief. So we need to compute marginal relief accordingly. Okay, so wherever there is an element of surcharge involved, we need to check while computing our answer as to whether marginal relief will apply or not, and accordingly compute and provide for marginal relief. But it is really not necessary to check for marginal relief every time, because in a question there may be several instances where you may need to compute surcharge. So marginal relief will not be available in all the cases, and therefore to save time, what I've done is in the table I have given you a range. Okay, so only if the total income falls within this range, you may need to check whether marginal relief will be available, because if the total income is beyond this range, then marginal relief will not be applicable. Okay, because A will not exceed B in that case. So usually marginal relief will be available up to a little over the total income level, where surcharge starts to apply or its rate changes, right? So basically we are talking about the threshold of 50 lakh, 1 crore, 2 crore and 5 crore. So marginal relief concept will apply to a total income range which is slightly over this particular threshold, right? An approximate range is given in the table for ready reference. If the total income given in the question falls within this range, then you should check for applicability of marginal relief. Otherwise, there is no need. So range of total income for marginal relief, and mind you, this is approximate, right? So between 50 to 52 lakh, if the total income is in question, then you need to check 1 crore to 1.03 crore, 2 crore to 2.1 crore, and 5 crore to 5.31 crore is the range where you should actually attempt to check applicability of marginal relief and compute it accordingly. So what are the steps? Basically, based on the discussion above, the following steps can be listed to determine surcharge and marginal relief. So step number 1, compute the total income and then bifurcate it into A and B. A and B is what? Dividend 11A, 112, 112A income. These are the incomes in respect of which when you compute tax, then the surcharge on that tax cannot exceed the rate of 15%. Okay, so this is A, and then B is the other income, right? Second step is determine the rate of surcharge on the other income, right? Based on the levels which we have seen in the table above, in this table. So determine the rate of surcharge based on the level of the other income, whether it is 10%, 15%, 25% or 37%. In any case, rate of surcharge on dividend 11A, 112 and 112A cannot exceed 15%, right? If the total income is within the marginal relief range referred in the above table, that means in this particular range, then check for marginal relief and allow it where applicable. And step 4, lastly, determine the amount of surcharge adjusted for marginal relief in any and add it to the amount of tax. So that will become the amount of tax plus surcharge. After you have arrived at the amount of tax plus surcharge, in case surcharge is not available, only tax, and if rebate has under section 87A needs to be applied, then tax on total income minus that rebate. On that amount, HEC, health and education cess, will be levied at 4%. That means on 4% of that amount, 4% of tax and surcharge, or 4% of only tax, or 4% of tax minus rebate, in all the cases, irrespective of the amount of total income. So cess at 4% is applicable in all cases, in the case of all persons, irrespective of the level of total income. Just one point to note, marginal relief is not available on cess. So it is available only in respect of surcharge. It's not available in respect of cess. Okay. Now we'll talk about rebate of tax in case of certain individuals, and this is provided under section 87A. Rebate under section 87A is allowed to whom? It is allowed to a resident individual. That means it's not allowed to an individual who is a non-resident, and it's also not allowed to a non-individual. So it's only allowed to a resident individual whose total income does not exceed 5 lakh. So only if the total income is up to 5 lakh, rebate under section 87A is applicable, otherwise it is not applicable. And rebate is allowed before adding cess. It is allowed before adding cess, and this is something that we have already discussed at the beginning of this video, that we need to first find out the tax on total income, and then straight away firstly we need to deduct rebate under section 87A if that is applicable. And in such case surcharge obviously won't apply because the total income will be beyond 5 lakh. Okay, because surcharge is not applicable till the total income crosses 50 lakh. And from rebate minus 87A, whatever is the balance, we add 4% cess, which brings us to the total amount of tax liability. Okay, so the stage of allowing rebate is to allow it before adding HEC, that means cess. And what is the amount of rebate? Rebate is lower of tax on total income or rupees 12,500. Okay, so the maximum amount of rebate is rupees 12,500, and as we discussed above, marginal relief is not available in this particular case. Rebate under section 87A is not available from tax on long-term capital gain under 112A. This is what we need to remember. So it is available from tax on all other incomes except long-term capital gain under 112A. So if in the question you have LTCG under 112A, then whatever tax you compute on this income, you are not supposed to allow rebate under section 87A in respect of that tax. So rebate under section 87A cannot exceed the tax on total income. So tax cannot become negative. That means you cannot claim a refund on account of this rebate. So if the tax is 12,500 and the rebate, maximum rebate is 12,500, tax will become nil. It cannot become negative. Okay. And rebate is not really relevant for a super senior citizen, as we discussed some time back that tax is anyways not leviable up to a total income of 5 lakh because that's the basic exemption limit in the case of a super senior citizen. And therefore rebate under section 87A is not really relevant for such person. Okay. So far we discussed about the rates for individual HUF, AOP, BOI and AJP. Right? Now we are going to discuss the rates of tax, the rates of surcharge, and the formula for marginal relief and rate of cess for other persons. Okay. So in this table, we have given who is the person, what is the rate of tax, the rate of surcharge, the formula for computing marginal relief, and the rate of cess. So in case of a cooperative society, there are slab rates which are applicable. So 10% tax up to a total income of 10,000 rupees, total income above 10,000 and up to 20,000, the rate of tax is 20%, and total income above 20,000, the rate of tax is 30%. There is no surcharge up to a total income of 1 crore. Total income beyond 1 crore and up to 10 crore, the rate of surcharge is 7%, and for total income greater than 10 crore, rate of surcharge is 12%. And marginal relief, the concept is basically the same as we discussed in the case of individual HUF, AOP, BOI and AJP above, wherein tax plus surcharge that we compute in the normal manner cannot exceed the following amounts. Cannot exceed the following. So where the total income is greater than and up to 10 crore, okay, the tax plus surcharge cannot exceed tax on 1 crore, which basically corresponds to this threshold 1 crore. So it cannot exceed tax on 1 crore plus total income minus 1 crore. Similarly, where total income is greater than 10 crore, the tax plus SC cannot exceed the amount computed as per tax on 10 crore plus total income minus 10 crore. So it will be good to remember these formulae for marginal relief both here as well as what we discussed above, and the cess is 4%. So cess is 4% across all cases, across all persons, whether it be individual, HUF, AOP, company, cooperative society, any person, the rate of surcharge will always remain, the rate of cess will always remain 4%. In the case of firm, and firm, we have already noted in the first video that firm includes LLP. So in the case of a firm, the slab system is not applicable and there is a flat rate of tax on total income at 30%. There is no surcharge up to a total income of 1 crore, beyond which the rate of surcharge is 12%. And this is the formula for determining the amount of marginal relief, and the cess is 4%. Similarly, for local authority, the rate of tax is a flat 30% with no surcharge up to a total income of 1 crore, beyond which the rate is 12%, and this is the formula for determining marginal relief, and the cess is of 4%. Right? As far as company is concerned, you need to figure out whether the company is a domestic company or a company other than a domestic company. Now, what is a domestic company? Now, it has been defined. There is a specific definition to it. We will not deal with this in detail, but to be brief, a domestic company is a company which is basically an Indian company. What is an Indian company? It is a company formed and registered under the Indian Companies Act. Consequently, a company which is not a domestic company is a foreign company. So we need to check whether the company is a domestic company or it is other than a domestic company. If the company is a domestic company, then we need to check the total turnover or gross receipts. Total turnover or gross receipts of the company in previous year 2021. Okay. In this table, we are talking about the tax rates for assessment year 2023-24, which corresponds to previous year 2022-23. However, the turnover or gross receipts are to be checked for 2 years back. That means for previous year 2021. If this is not greater than 400 crore, the rate of tax is a flat rate of 25%, else the rate is a flat rate of 30%. There is no surcharge up to a total income of 1 crore. Beyond 1 crore and up to 10 crore, the rate of surcharge is 7%, and beyond 10 crore total income, rate of surcharge is 12%. And this is the corresponding formula for determining the marginal relief, and cess is to the tune of 4%. If the company is other than a domestic company, okay, if the company is a foreign company, then as far as income in the nature of royalty or FTS is concerned, FTS, fees for technical services, the rate of tax will be 50% flat on such income, and on the balance total income, the rate is a flat 40%. The rate of surcharge is nil for total income up to 1 crore. Beyond total income of 1 crore and up to 10 crore, the rate is 2%. So it is lower than 7% in the case of domestic company. And the rate of surcharge for total income beyond 10 crore is 5%, which is less than 12% in the case of domestic company. So the rate of surcharge in the case of foreign company, it is slightly lower than that for a domestic company. And the reason is that the base tax rate for a foreign company is higher than the base tax rate for a domestic company, and that's why the surcharge is taxed at a slightly lower rate. And this is the corresponding formula for determining marginal relief, and the cess, of course, is at the rate of 4%. Certain special rates of tax have been provided under the Act in respect of certain types of income, and there is a differential treatment in computation of income and tax which has been basically provided. As far as capital gains is concerned, there are basically 3 sections, 111A, 112A, and 112. These are the sections that we discussed some time back while discussing the concept of limit of surcharge of 15%, right? And in these cases, the capital gain is basically taxable at a special rate. And 111A is the short-term capital gain. Okay, when we talk about transfer of equity shares in a company or unit of an equity-oriented fund on which securities transaction tax is leviable, then if it is short-term capital gain, then 111A applies and the rate of tax is a special rate of 15%. If such gain is long-term capital gain, then a special rate of 10% applies on such capital gain which is in excess of rupees 1 lakh. So a threshold exemption of 1 lakh is given. So beyond 1 lakh, if for example capital gain is 1,50,000, then 10% will apply only on 50,000, not on 1,50,000, right? And in respect of other capital assets, if it's long-term capital gain, then 112 section applies and the special rate of 20% is applicable. If it is a normal case of short-term capital gain, then special rate doesn't apply, then it forms part of the normal income and the slab rates which we have discussed above apply in that particular case. So as far as capital gains are concerned, three situations are there in which these special rates of 10%, 15% and 20% apply. Surcharge is something that we have discussed above. It applies as per the table that we had seen above, and the rate of surcharge in such cases cannot exceed 15% if the person is an individual HUF, AOP, BOI or AJP. Cess is 4%. There is a special rate if the income is in the nature of winnings from lotteries, races, games, etc. And the relevant section is section 115 BB. In such cases, in case of such income, a flat rate of 30% is applicable. In the previous video on the basic concepts, we had discussed undisclosed incomes, where there was unexplained money, investment, expenditure, etc. And we had discussed that such provisions are contained in section 68, 69, 69A, 69B, 69C and 69D, right? In such cases, no deduction of any expenditure or allowance or set off of any losses provided. That means the income is taxable on gross basis without allowing for any allowance or deduction whatsoever, right? So on gross basis, taxation happens and the rate of tax is a flat 60%, on which surcharge is applied at the rate of 25% and cess at the rate of 4% is applied on the aggregate of tax and surcharge, right? So this is the provision under section 115 BBE. In case of buyback of shares by a domestic company, the shareholder is not supposed to pay tax. Instead, the company is supposed to pay buyback tax, and this tax is leviable on distributed income at the rate of 20%, to which surcharge is added at the rate of 12%, and of course cess is at the rate of 4%. So rate of tax ranges from 10% minimum, which is under section 112A, to a maximum which can go up to 60%, which is in the case of undisclosed income, right? Surcharge is a flat rate of surcharge at 25% in case of 115 BBE, that means undisclosed income, and 12% flat in case of buyback tax. And in case of other provisions, the surcharge applies at the rate that we have discussed so far in this video, with the limit of 15% of surcharge in the case of 111A, 112A and 112, where the person is an individual HUF, AOP, BOI or AJP. Cess applies at the rate of 4% in all the cases. One concept is regarding UBEL. UBEL is the concept of unexhausted basic exemption limit. Okay, as we saw, the basic exemption limit can be 2,50,000, 3 lakh or 5 lakh, depending on whether the person is a normal individual or a senior citizen or a super senior citizen, etc. Right? In certain cases, in the case of company, etc., there is no unexhausted, there is no basic exemption limit. But where there is a basic exemption limit, there is a benefit of UBL which is provided, and this is provided to a resident individual or HUF. This is provided to a resident individual or HUF. What we do basically is we compute the normal income, that is income which is other than 111A, 112A and 112. Basically the income which is other than the capital gain taxable at special rate, we compute that income, and if that amount of other income is less than the basic exemption limit itself, then what we do is that we determine the deficiency and we reduce that deficiency from the capital gain. So we then compute tax on that reduced amount of capital gain. So that is giving off the benefit of an exhausted basic exemption limit while computing tax under section 111A, 112A and 112. So that's why this benefit of UBL is only applicable in these particular three cases. It's not applicable while computing tax on winnings or on undisclosed income. Next is this concept where we do not provide deduction under chapter VIA from the gross total income, right? So as we know, we first compute the gross total income and then we provide deduction under section 80C, 80D, etc., from the gross total income, and these are contained in chapter VIA. We are not supposed to provide these deductions in respect of incomes which are taxable at special rates. So deductions under section VIA are not available in all these cases. As far as the rebate under section 87A goes, when we compute tax on long-term capital gain under section 112A, right? We have already noted some time back that 87A rebate is not supposed to be provided in respect of that tax. In other cases, 87A benefit is available. So this is a quick snapshot of the relevant provisions where a special rate of tax applies. So this brings us to the end of the fast track revision quick summary video of chapter 2, which deals with the rates of tax.